Well, folks, I have quite a good video for you here today. I spent the last several hours prepping this video. I got a lot of data information to show you in this video. Some of this you might have seen in the channel in the past. Some of this you've probably never seen in your life. And I got a lot of perspectives. We got to talk about the Fed. We got to talk about where the market's going. We got to talk about how disappointing this market is. There's so much we got to get into in this video. We got to talk about valuations and whatnot. So this one took me quite a while to prep, probably the longest prep I've done on a video in quite some time. So I do hope you guys enjoy it, okay? So first place I want to start out here with this video is talking about how disappointing of a trading day this was here today. This was extremely disappointing, and the reason this was so disappointing is three of the major indexes, S&P, Russell, Dow, all finished down for the day. NASDAQ barely eked out a gain. Today was supposed to be one of those kind of like, they call it like a dead cat bounce day essentially, where you at least recover a little bit. And the fact that we got almost all red here today, and after futures were looking very, very green last night when I went to bed, it's just very disappointing day. When you come off of this sort of day, yesterday the NASDAQ was down 4+%, the Russell was down 4+%. When you come off of a day like that where it's literally devastation, that's a pure devastation day. That's a capitulation type day. The next day, the next trading day, you expect to at least get a little bit back. And the fact that we went even more red on the Russell, the Dow, and S&P was just extremely disappointing when you come off of that sort of day. And, that hurts, okay? That hurts the market, and that hurts the psychology of the market big time. Now, the Russell here today in the trading day, actually at one point was under 1,700. We haven't seen it in the 16s in quite some time. So the fact that we saw that in the Russell just continues to show how weak the Russell really is and how weak it's been. This is a 5-year chart. The Russell's now only up 21% in the past 5 years. In the past 5 years, the Russell 2000's up 21%. It's just insane to think like the Russell is only up that much. And now imagine a scenario where the Russell goes down another 20% and all of a sudden the Russell is negative on a 5-year basis. Like, that's crazy to think, right? But if you look back at past really, really bad crashes, the indexes can go back several years. I pulled this up in a video recently where I went back in history and I showed essentially how far some indexes would fall essentially. And what we found is very customary. It's a 1 to 2 year drop, meaning essentially the index will go back to wherever the index previously was a year or two ago, okay? But in the major crashes, it's a 4 to 6 year gap. Okay, and so that is something to kind of keep in mind. And the Russell's performing in line. I mean, look at this here today. We were back at levels we were back in 2018. That's 4 years ago. So this is playing out exactly how a vicious crash would. Now look at this. This blows my mind. When does a selling stop? Seriously, when does the selling stop? I look at Shopify here today. This stock is down again today, another 3%. The stock is down 77.7% year to date. I mean, this is one of the most impressive companies you'll ever find in the stock market. And this is equivalent of somebody being knocked out and somebody still kicking them while they're knocked out on the ground. Like, when does a pain end? When does a pain end for a stock like this? Now, with a Shopify, I know what the argument will be on the other side. If somebody wants to talk down Shopify, they'll say, high valuation name, okay? Okay, let's talk about some other stocks that are being kicked while they're down. What about PayPal? Is that a high valuation name at a 23 PE ratio? Heck no. This stock is down again today, almost 63% year to date. PayPal's down now. This is not some kind of high valuation name. So, this whole notion of, it's just bad stocks. No, name brand stocks too are just getting kicked, again and again down. It's not just high valuation stocks. That's not the truth, okay? Netflix, this stock is now down 72%. Like, when does this selling? And that's year to date. We're 6 months into the year. Like, when does the pain stop? When does the pain stop for these stocks? Look at Meta. We're talking about one of the biggest companies in the world, a platform that almost everybody uses, one of their platforms, whether it be FB or IG or WhatsApp. And you look at this, it's at a 12 PE ratio. Oh, 12. You're going to be flipping my flapjacks. And the stock is now down over 51%, was down again today. Like, when does the pain stop? When is enough enough, okay? I saw FedEx here today, right? And FedEx had about the best day it's ever had, or the best day since I think the 80s in terms of its stock price, in terms of a percentage up. Just a great day for FedEx. They announced they're up in their dividend. They announced also they're going to focus more on shareholders and trying to get gains in the stock price and things like that. That's basically what they said. Volume went crazy on the stock here today. Over 12 million shares traded. Average volumes, 2.4 million. So incredible day for FedEx. You know what the first thing I thought of? The first thing I thought of when I saw this FedEx gain here today, the first thing I thought of is I thought, man, how many trading days until it loses all those gains? Is it this week? Is it next week? And that's the sort of market we're in right now, in all seriousness. And that's a scary market when you don't trust any gain with any stock. You see a stock go up and you're like, how many days until it loses all those gains? Because that's exactly what we've seen play out. I've seen small caps, mid caps, large caps, where they will go up, right? And they'll have a good day, they'll have a good week, all to be back down lower to where they even were just a few weeks later, just a month later. And I've seen it play out with stock after stock after stock. And so that's the sort of market we're in right now, where something like a FedEx, you can't even trust the gains, even on a good day like this. And it sucks as a shareholder of these sorts of any company, honestly, right now, because you usually you can get excited about it. Oh yeah, we did something good. Oh, we raised a dividend, or we beat in earnings, or revenue came in better than expected, or EPS came in better, or margins came in better. And you usually can get excited about a green day. Not in this market. All you're like is probably just a fake out rally, and we're probably down to even lower lows just a few weeks from now. And that sucks, man. That's demoralizing as an investor, okay? Now, before we get into the juicy parts of this video that I got to share with you guys here today, FTX US, that is the official crypto partner of the channel. You might have seen them partner with folks like Steph Curry, Tom Brady, and others. You can basically do recurring buys right through FTX, where essentially, let's say you want to buy, $20 of Ethereum every single week or once a month or something like that. You can set up your account to do recurring buys. That's pretty darn amazing, so you don't have to worry about managing all that. They have the fees that are among the cheapest in the industry. You get free crypto in every trade over $10. Also, FTX just got into stocks recently, so that's a huge development that's happening with FTX. Really good news. And one thing also I think is worth mentioning is FTX is very well capitalized. They just raised $400 million a few months ago, and in a time period when other crypto companies have had issues. FTX has not been part of that, and so that's great news for obviously everybody that uses FTX. If you're going to use somebody in this space, you want to use the most reputable companies, and FTX is that sort of company. Okay, and right now you can get up to $100 in crypto by using my link down there, setting up an account, making a deposit, and using referral code Holy Smokers to get up to $100 in crypto, which is pretty darn awesome. That will be pinned comment down there to take advantage of that. Target. This goes to show you how bad this market really is. This stock just hit a new 52-week low here today, right? P ratio on this is under 12. P ratio under 12. The dividend is 3%, okay? That's how bad this market is. So, you can't just say, oh, it's bad, stock's doing bad. Hell no. If anybody says that, they're not very educated. They don't keep track of enough stocks, I think, apparently. Because the fact is, you see every single company. Doesn't matter if they're speculative, not speculative, high growth, low growth, dividend, not dividend, low PE, high PE, low price to sales ratio, high price to sales ratio. It doesn't matter in this sort of market. Fundamentals are thrown out right now, because no one really has any clue what is going to happen in the economy. And when people are very scared about what's going to happen in the economy, they get scared about what's going to happen with earnings. They start to not trust anything. They start to basically not want to buy anything at any price. And that's exactly what you see play out with a great company like Target. Like, they're the most well-run retailer in the world, to be quite honest, as far as like a physical retailer. Amazing company, but no one wants to buy Target. And that's why you see the stock hit a new 52-week low after new 52-week low after new 52-week low, despite being a cash flow machine, despite being a great profitable company, despite having a great dividend yield on it. despite having a great next 5 to 10 years in front of the company, there's just nothing that stock can do in the short term to help themselves out, right? Now, we did see a little encouraging signs in some stocks here today. I looked at the Chef. Personally, I was not buying the Chef here today. It was not a buy day for me. I didn't buy any stocks here today. It was just not a buy day for me. But, it was interesting seeing volume actually come in pretty strong. 471,000 shares traded. Stock ended up finishing green today. After hours green. So, there is an investor conference for the Chef tomorrow. Maybe somebody knows something, or maybe somebody's just playing that conference. I don't know, but that's definitely some encouraging thing to see if they're thinking about kind of the stock price. Same exact thing with Oatly, right? Oatly saw a very similar trend here today. Almost 4.4 million shares traded. That's a pretty good volume number on a day like today with no big news with this stock. Average volume 5.1 there. Stock ended up finishing up today after hours up as well. These companies like the Chef, Oatly, those are game-changing companies. These stock prices we're looking at today are just a joke compared to where they're going to be in 3 years from now, 5 years from now, probably even in honestly 12 months from now. But I think people are wising up to understanding these companies maybe on a higher level, and understanding how much growth they have and how margins are just going to get better year after year after year, and the profitability is going to explode for these companies over the coming years. Now, you look at a stock like RH. I can understand the stock being down. I actually like RH for the long term. I'm not buying the stock. I don't own the stock. I might own the stock in the future, to be honest. But RH is, the stock's down 54%. It was down again today in regards to RH. I can understand that stock being down and just continue to fall. The reason being is housing is going to be in a bad place for at least the next year or two. And I got some really scary stuff to show you in regards to housing in a moment here, okay? But essentially, I can understand that, right? It makes sense. Target continue to throw that and new 52-week low after 52-week low. I don't know about that. I'm not so convinced there, right? RH, housing stocks, home builders, things like that, I can understand that. That makes sense to me, right? So, unfortunately, in these sorts of stocks, there's probably a lot more pain ahead before things get better there. Safety stocks. Look at this. Look at this here today. Coca-Cola massively underperforming the market, down 3.4%. Look at a stock like Clorox today, down over 3% today. Procter & Gamble down over 3% today. Pepsi down 2.2% today. What's going on here? The safety stocks massively underperforming the market. This is supposed to, this is where they say, oh, you're not going to lose money on these stocks, okay? Nah, it doesn't look like it, okay? Those stocks continue to be hit again and again and again and again and again and again. And that's the sort of market we're in. But this makes sense. Now here's why this makes sense, okay? We're in what I would call the later stage of a market crash. Does not mean you're at the end, but you're at the later stages. This has basically been almost a year and a half in the making. Actually, it has been about a year and a half in the making. First thing that got hit was small caps, speculative stocks, right? Next thing that got hit was mid caps. Next thing that got hit was, tech stocks, growth stocks, right? That really started about November. Next thing after that was overall big tech. And at the last stage of a market crash, the last stage of a market crash can last anywhere from 3 months to potentially 9 months. But in that last stage of a market crash, everything is getting hit. Doesn't matter if you're Coca-Cola, doesn't matter if you're Procter & Gamble, doesn't matter if you're those safest companies, a Target, new 52-week low, right? I think Target's one of the safest companies anybody could invest in, but doesn't mean a stock's not going to continue to get hit, right? When you're in the final stages of this game of a market crash, everything goes down, and it just goes down more, and it goes down more, and it goes down more. And eventually you finally reach a bottom, but that's just the way it is. So, when you see this, guys, don't be surprised by it. Understand the cycle you're in. Understand the stage of the market crash you're in. And at the final stage, everything's getting hit. I remember when I first started investing, I started at the end of 2008 going into 2009, right? And I remember some of my first companies were some of the safety stocks like Kimberly-Clark and Walmart and Walgreens and some of those companies that were the safest of safe companies. But the thing I noticed is even those stocks, when I was first starting to buy them, they actually were going lower. They actually were getting hit. And I'm like, wait, aren't these supposed to be the safest companies? Why am I losing money? Why is my account going lower on these stocks? I'm trying to figure out this whole stock market thing. And, I didn't know a lot at that time. I didn't understand the stage of the crash we were in. Now, what I should have been doing is I should have actually been buying the more speculative stocks, the growth stocks and things like that. That would have been the smart decision to make. Instead, I was trying to buy the safety stocks because I was looking at all those, the more growth stocks and things like that. And I was like, oh man, those companies are getting hit so hard. These ones are holding up well. Let me invest in the safer companies. All along, that was the stupidest idea. I still ended up going down on my accounts in that short term there. And meanwhile, coming out of that whole situation, guess what? Stocks were 2x and 3x and 4x and 5x and in a matter of the next 6 to 18 months. It was not Kimberly-Clark. It was not Walmart. It was not Conagra Foods. And the stocks I was buying is not Walgreens. It was all the more growth stocks. It was the stocks that were seen as more speculative, more risky, that had already been hammered, 50, 60, 70, 80%. Those were the plays. And, but you got to understand the cycle you're in a market crash. And we're in this sort of cycle now where safety stocks are getting obliterated. Now, what I'm showing you right here, this shows you kind of past bear markets and recoveries. Now, the important thing to understand about this chart from Investopedia here is this doesn't show you every single bear market. For instance, we actually had a bear market in late 2018 where the S&P 500 was down over 20% essentially, okay? But folks they don't recognize that historically as a bear market. In order to be a bear market historically, you not only have to have the S&P 500 go down 20% plus, but you have to have it kind of be for a longer time period, and you have to have everybody have felt the pain and really paid attention to it. So 2022, this is a year that's going down in the history books. Everybody's going to remember this year in the stock market. But unfortunately, some of these years in the past that were, in my opinion, real bear markets didn't get recognized because they weren't there for long enough, and so they weren't recognized. Okay, so this kind of just shows you some of the worst of the bear markets. Okay, now something that's interesting here is it's not very natural to get a bear market into another bear market in a short amount of time. So for instance, obviously we had the bear market February, March of 2020. And now we're already in bear market again. S&P 500 is down 20% plus. So that's not natural to get bear markets within a 2 to 3 year span, but it does happen every once in a while. Okay. For instance, February of 1966 and in November of 1968, you had two separate bear markets there, okay? You had one in 87 and then another one in 1990. So it's not impossible to get a nasty bear market within a 2 to 3 year span of another bear market, all right? And that's kind of what we're going through right now. And this one, as far as when the market turns, I'm not expecting as rapid of a acceleration in terms of how fast things turn, but it depends. It depends. Let's say we start to get mass layoffs and there was real capitulation in the overall markets. Let's say in the back half of this year and VIX goes to 40 or 50, then we will have a violent rally back, essentially. The way to kind of think about this is the higher the VIX goes, essentially, okay, and the more fear there is in the market, the more volatility, the more likely you're going to have a incredible snapback rally. If the market goes lower and lower, but the VIX is not at 35, 40, 50, those sorts of ranges, then when you do start to recover, it's usually going to be a slower recovery at the top, which is not a bad thing, right? And actually, as a long-term investor, it's actually better to have those slower recoveries because you can be a buyer, not just as the stock market goes down, but then as the market goes up, you can be a buyer and you get into positions. Something that sucked about the bear market of February and March of 2020 is a lot of investors, including myself, didn't really get to add as aggressively because it was such a snapback. It happened so fast. It was down so quick. It was the fastest stock market fall ever. And then it was up in a straight line. And so you didn't really get to build out your positions. This, for long-term investors, a market we're going through right now, this is the best situation for a long-term investor because you're able to buy for months and months and months and months and months as the market goes lower. And then as the market recovers, hopefully it doesn't go up in a straight line and it slowly starts to recover, and you're going to be able to build your positions bigger and bigger over let's call it a 12-month to 30-month span, essentially, right? Between going down in the market and then going up. That's the ultimate ideal market for a long-term investor. Traders might not like that because they like the action, right? They want it to, everything to be going crazy. But for a long-term investor, that's actually the best scenario. The best scenario. The things that happened, in 2020, that was not the best scenario. No one got to build positions the way they really wanted to. So yeah, sure, Uber went super low and all the growth stocks and Tesla and everything went super low, right? But did you really get to build the positions you really wanted to build? No, you didn't, because it happened too fast. It was down and was straight back up. So, I think this could be actually a much better market for long-term investors now. Now, the Fed is likely going to raise interest rates by 75 basis points. Now, this matters for many various reasons, okay? First thing I want to touch on here, essentially, is I think the higher they go, here's the thing, okay? Usually, if the Fed's raising interest rates, the higher they go, the more the market does not like that, essentially. The more the market's freaked out, the more the market's likely to sell off, right? This is a very different situation for once. I think the higher the Fed was to raise interest rates, the more the market actually is going to potentially like it. And I know that's counterintuitive and that's weird to even think, but I think actually big money is trying to force the Fed to raise interest rates as rapidly as possible and as much as possible. And I think the reason being is they really want to see inflation tackled, okay? Now, some of these things, raising interest rates by, let's say, 1% tomorrow or 75 basis points or whatever, right? It's not going to magically make inflation go down all of a sudden instantly. It's not the way this happens. It has to play out over a given amount of time. And there's some things that even with the Fed raising interest rates, it doesn't necessarily fix all the inflation problems. That's just the bottom line. There's certain things that are out of the Fed's control, to be quite honest, when it comes to inflation. They wish they could control it, but it's not always that way. But there is one thing we do know. With Fed keeps pushing interest rates, I almost think it's like a guarantee we're going into recession, but the more they're going to raise interest rates, the more likely we're going to push into recession, right? So it's something to keep in mind, but the market honestly wants to see the Fed tackle inflation by as much as possible. I think that's what big money wants to see. I think if the Fed came out with a low number tomorrow, maybe only raise 50, I wouldn't be surprised if the market sold off, to be honest, even though, usually that would be a better situation. The Fed's not being as aggressive. That's good. But in this situation, I think big money, they want to see the Fed come in with the hammer and get kind of their respect back and those sorts of things, all right? Now, 30-year, speaking about interest rates and why this matters so much, what the Fed does can move the 10-year. What the 10-year does can move mortgage rates. Here's the deal, guys. Mortgage rates are now over 6, okay? Mortgage rates just a snap of fingers ago were in the 2 to 3 range. So the fact that we're pushing 6 plus, and I've talked about this for a long time, I said this summer, get ready for 6 to 7% interest rates on 30-year mortgages. And it's exactly what's playing out here. And it's not going to get better in the short term. That's the problem. It's just going to get worse. Real estate's done. Real estate is done. And because real estate's going to be done for the next, let's call it 12 to 24 months, that's going to wreck the economy. I spoke about this in depth in a video not that long ago. And I explained essentially, when you start to dry up the amount of people going to buy new homes and things like that, you dry up construction. And there's so many jobs that are supported for that. It's in my opinion, it's the most important industry in the United States of America because of how many jobs are created when a new home is built. And it's all usually almost always built on debt money. That debt money is not going to be used to build new homes, essentially. And so we have this next 6 months of all these homes that have already been bought 6 months ago, 12 months ago that are being built. And then 23 is just going to be a complete disaster for new homes built. Lennar's numbers are going to be horrible. Toll Brothers' numbers are going to be horrible. Pulte Homes' numbers are going to be horrible. It's going to be awful. I mean, absolutely awful. Could we go back to 2008, 2009 type numbers in terms of how many homes they're building? I wouldn't be surprised. That's how bad I'm expecting in terms of the new home construction. I think it's going to dry up massively. Home sales are already starting to dry up. It's going to get way worse. And it's still kind of funny. I still see a little bit of a debate on if we're going to have if real estate's going to get super weak or not. There will be no debate by the end of the summer. I promise you that. Every single human that knows anything about economics is going to be like, oh yeah, real estate's bad. It's bad. And that's where we're going here. And Unfortunately, when it comes to these 30 years, it's not magically fixing itself, and it's just going to make the situation worse. And so then the only people you're counting on to essentially buy homes or new homes or whatever are cash buyers. But cash buyers are seeing everything, go down to the ground right now. Why, if you got cash around, do you need to go buy a new home right now? Heck, no, you're not, dude. If you got that sort of money around, you're not looking to go buy a new home right now. Heck no, because you understand it's a high probability that in 6 months or 12 months, you're going to get that home for far cheaper. So why go buy now? Plus, you have all these other opportunities in front of you. So why would you want to go spend your cash on a home right now? When, let's say you want to buy crypto and that's down massively. Let's say you want to buy stocks and those are down massively. Who would go buy a new home right now? Cash, that ain't happening, okay? So, anybody that has got a brain understands, no. That's not what you're doing with your money. If anything, you'd rather just keep your money in the bank than put it in real estate right now, okay? So, this situation is getting worse. Now, also with the Fed raising interest rates, it's going to raise, guess what? Unfortunately, margin debt's going to be even more expensive. So if the Fed's going to raise 75 basis points, the amount you're going to pay on margin is going to be 75 basis points more, okay? Which means it's much more expensive to try to take out debt to invest in stocks or trade in stocks, which means essentially it hurts the market. It hurts the market. Now, I like that margin debt's coming down. Usually margin debt and S&P 500 usually pretty much move together, essentially. That's just the way it is. That's the way it's pretty much always been. And, as the S&P 500 falls more, margin debt will continue to fall more. That's just the way this plays out. These babies go up together, they go down together. I really want to see margin debt in the $500 to $600 billion range. At the peak, it was around $1 trillion. I think we're going there. To be quite honest. I think it's going to be very, very soon here that we'll see 500 to 600 numbers for margin debt, okay? Now, I haven't pulled this up for a while. This looks at forward Ps for small caps and mid caps from Yardeni Research, and we continue to be at these insanely low levels. But the thing is, we've been at these insanely low levels for quite some time now, to be honest. I remember I was first pulling these charts out 6+ months ago. And so, this is not something new. Obviously, long term, this is not sustainable. I think we all know that, right? As when you go up to these extremely high ranges, that's not sustainable either, right? But it's just like when do things move here? When do things move? We might have to wait a bit more here. All right, S&P small caps are trading at 11.2 forward P, but people don't want to take risk in anything right now. People don't even want to take risk in large caps. So how can small caps do good in a market that people don't even want to take risk in large caps? People don't even want to buy Meta right now. People don't even want to buy Target stock. So when you're in that sort of market, man, it makes it so tough for smalls and mids to get any sort of momentum until you get that real turn in the market, right? And that real turn with the Fed, which likely is not coming right now. And so that's why right now you're just getting this insane opportunity to load up and valuations that are among the cheapest, to be honest, you've pretty much ever gotten a chance to buy. If you've been in the stock market for whether it's been a year or two or whether it's been 20 years, you've never really gotten a chance to buy mid caps and small caps this cheap. This is one of those very few opportunities you'll ever get in life where you can get them for that dang cheap. The interesting thing is large caps have come down so much now. S&P 500 large caps, 15.7 now we're at. So I love this. I absolutely love this. I think we need to go lower, unfortunately. I think we need to get more into the 13, 14 range is I think really where we need to go, somewhere in there. And I wouldn't be surprised if we end up going there, but this is great to see this playing out because, for a long time we were at these very unhealthy levels. And whenever you get at these sorts of, 26, a 20 to 26, you're on very unhealthy levels for the market and you just know you're likely going down, right? And so, the fact that now we're in normal ranges is great to see. And I think it would be even better if we went down a little more. And because then folks start to look at the market and they say, I just got to start taking risk here. Like I can't pass on these stocks trading at these sorts of valuations. Mid caps and small caps freak a lot of people out. Large caps do not. So that's where, I love seeing opportunity there. Now, if you notice here, the banks continue to move to new lows after new lows. This is JP Morgan I'm showing you here. Okay. JP Morgan Chase. This company just reached another 52-week low. Now, the reason this is very important the reason this is very, very important, and it's trading at like an 8P ratio, is this shows you essentially that the market is ultra scared. When you see the biggest of the big banks out there fall to new 52-week low after new 52-week low, despite interest rates going up, which was usually seen as like a good thing for banks, right? When you see that playing out, this is bad news. This is bad news. That means essentially Wall Street is scared about themselves. Wall Street's scared about Wall Street, which means here's the deal. The stock market's a mess. We all know that. The bond market, which not a lot of people keep up to date, is even a bigger mess. All right? Real estate's going to become a mess. We have a lot of things that are going on with mortgage-backed securities and things like that that are looking really, really ugly now. And so, nonetheless, the banks could be in much bigger trouble much quicker than I think a lot of people anticipate. And because that is a situation, it is causing massive fear and panic, obviously, on Wall Street. And so Wall Street is scared about themselves. And if Wall Street's scared about themselves, that definitely should make your ears perk up a little bit on kind of what's going to come in the economy over the next, let's call it 6 to 18 months. All right? That is something, and here's the thing. If you think it's just JP Morgan, it's not. All the banks are reaching new 52-week low after new 52-week low. Look at Wells Fargo today. Market was not even down huge today. Wells Fargo down 4%, down to $37 a share. Bank of America down big. Like all these stocks just break through new 52-week low after new 52-week low. Wall Street's selling Wall Street because they understand that we're in a messy situation and the banks could end up going from a situation where they were making so much money to having losses. It's not impossible to see, and I'm not going to predict this, okay? I'm not going to predict this. I'm just going to put it out there, okay, to the world. It's not impossible for a company like JP Morgan to lose money in 2023. It's not impossible for a company like Wells Fargo to lose money on the bottom line in 2023. That can happen. That can play out. No one is expecting that right now. But Wall Street selling Wall Street to new 52-week low after new 52-week low, almost understanding that this might be a possibility, but no one's talking about it. I've seen the banks before go from massive losses to massive gains. I've seen the banks before go from massive gains to massive losses. Look what the banks were doing in 2005, 2006, 2007 for net income, EPS. Look what the banks were doing in 2008, 2009. Look what their revenues were. Look what their net income loss was. Very important to understand that, guys, okay? Now, something that makes me still very concerned about the market is the biggest big dog company in the world, Apple. I think this baby has further to fall. Am I shorting? Heck no. But I think this stock has more to fall. I don't think it's out of the realm of possibility that this stock goes to $80 to $100. I really don't. And I don't think they're hitting any of their numbers. And I'm just not a believer. I'm just not a believer at all in Apple's actual fundamental underlying business for the next, let's call it 2 to 6 quarters. I'm really not. And so, given how weak the economy is, given how bad inflation's hit people, I think their iPhone numbers are going to be a disaster. For this next iPhone generation, I don't care how good their marketing is. I don't care if it's going to be the fastest phone ever, I'm sure, whatever, and it's going to have a better camera than the last generation. It doesn't matter. It really, to be honest, it doesn't matter. I just don't think the economy is going to support the next generation of Apple products. I think their sales are going to fall, and I think services is going to get hit as well. And Apple's trading at a PE that's much above where the stock usually trades at. So that's kind of like a triple bad, right? If the actual products aren't selling the way they're supposed to, services aren't moving the way services are supposed to move, and then on top of that, you got a company that's trading at a higher PE than it's historically traded at. I remember it was very natural to look at Apple and it as anywhere from like a 10 to 15 P ratio. When you start talking about 20, 22, 24, there wasn't that long ago, it was trading at 26. You're way up there. So that gives me a little discomfort in this market, understanding that Apple is such a big weight on the market and this baby could, unfortunately, be going lower, okay? Now, there's extreme fear of the market, right? we're in extreme fear. That's just the way it is we've been in extreme fear for a bit here. And, a week ago we were in fear. A month ago we were in extreme fear. That's just the way it's been for quite some time in the market. And so it's crazy as it sounds, you got to be a buyer in this market. And I'm going to keep preaching this. The next 6 to 18 months, this is I don't call this a lifetime opportunity to buy, but it's one of those very few opportunities you only get maybe every 10 to 20 years. You very rarely get these sorts of opportunities to load up on stocks for an extended period of time and add ownership of these sorts of companies. And we haven't had one of these. We haven't had one of these long periods of this since 08, 09. You haven't had one of those, right? So we're going through an elongated cycle here where you're going to be able to continue to buy. And whenever we bottom and we start going up, you're still going to be able to buy at very, very cheap valuations for a ton of these companies. And so you have to take full advantage of this. 2020 was a sneak peek at this, but it went too fast. The drop happened too fast and the upward move happened too fast. So retail folks did not really get the positions built out the way they wanted to. This 6 to 18 month window in front of your eyes right now, this is that once again, it's not a once in a lifetime opportunity. It's a once in every 10 to 20 year opportunity. You got this right now. And you got to take full advantage of this. And I mean full advantage. And you don't let your foot off the gas. You buy everything you possibly can that you love for the next, 3, 5, 10 years, and you load up on those companies, you throw them in the filing cabinet. Keep in mind, companies that have revenue growth despite whatever happens in the economy. Keep in mind companies that are expected to continue to grow margins over future years. Keep in mind companies that are expected to have their net income get in a better and better place than it is today in future years. That's very important. And also have good cash balances around so they can ride out this mess, okay? Much love as always, guys. I appreciate you joining me. I hope you appreciate a long beast video like this, and have a great day. Also take advantage of the FTX US deal. That is pinned comment.